Hello and welcome back to another demo video. Actually, it's our first demo video dealing with recording bond transactions. Okay, so I asked you to work on exercise 15-2, 15-3, and 15-4. Now, this is, as I looked over these problems, they're all pretty much very, very similar, right? So I'm not going to go through each and every one of them. I'm going to go through a couple of them. But what I really want to do is work on exercise 5-15 together, okay? Because that's actually a pretty good one, okay? So let's just start off with exercise 15-2, okay? Please notice how I set up the journal, right? I merged and centered 4 columns here to make sure that we have enough room to put our debits and credits. Please set your journal entry, or for your homework, whenever you have to do a journal, please set it up identical to this. The reason why is it makes it a lot easier for me to see into grade. And as I go through and start grading some things, I'm noticing that not everybody's uniform. Some people, there's a lot of people that aren't doing this. So always do this, meaning merge and center, left align, make sure you skip spaces in between the journal entries. So anywho, let's look at exercise 15-2. Exercise 15-2, which hopefully you've already attempted, issues a bond, $500,000, 10%, 10-year bond at face value, right? Interest payments are annual. This is super, super easy for us to do, okay? First thing that we need to do is to recognize that A, we borrowed cash from bondholders, really, right? So the first journal entry for A, actually, is going to be debiting cash for $500,000 and crediting bonds payable. Indent the credit. And 500,000. Okay. The next one says on December 31st, we need to accrue interest, right? Super easy for us to do. We've done this before, right? We're accruing an interest expense. I need to debit interest expense. And I need to credit, obviously, interest payable. Now, the only thing that differs is the calculation, right? How do we know what to pay interest on? Well, remember, it's always the face amount times the stated rate, or the contract rate. Okay. So in our example, we know that the face amount of these bonds is $500,000. Oh, let's do it this way. We know they're $500,000 times what's our interest rate? Well, the stated interest rate in the problem they tell us is 10%. We owe 50 grand in interest. Okay, so that's going to be the debit, $50,000 for interest expense, credit interest payable, $50,000. Okay, this was actually part B. Always skip a space between your journal entries, please. Part C says, now we got to pay the interest, right? On December 31st, we recognize the fact that we accrued interest. January 1 of the following year, we have to pay it. Super easy for us to do, right? I'm going to debit interest payable for the $50,000. And I'm going to credit, obviously, I'm going to credit cash for the same amount. Okay. For exercise 5-3, okay, 5-3 is identical, right, to what we have here. The dollar amounts for exercise 5-3, and I'm going to just put them over here. So we should have recognized that the bonds were issued at face value, which is $400,000. The interest expense that we need to calculate in exercise 15-3, face amount times the stated rate. In this case, it's the stated rate is 8%, and the interest payable, or I'm sorry, the face amount is $400,000. So the amount for the interest expense and the interest payable for problem 15-3 should be $32,000. Okay. There we go. And then finally, the interest payable for exercise 15-3, same exact journal entry. The dollar amount is $32,000. Okay. Looking at exercise 14 or 15-4, excuse me, it's identical, right? It's the same exact thing. Dollar amounts are a little different. In exercise 15-4, it's going to be $400,000. That's the amount of bonds that we issue. And again, it's going to be the same accounts, right? Cash, $40,000, bonds payable, $40,000. The interest expense for problem for B in 15-4, the interest expense, right? It's the stated rate is 9% on $400,000. That means our interest has to be $36,000. Okay. And then pay the interest. Okay, great. It's going to be the same exact journal entry. Interest payable, debited, credit cash for how much? $36,000. Okay. I just want to make sure that you have the dollar amounts. The journal entries are nearly identical. Okay. What I really want to look at is exercise 15-5, and I want to work on that together. Reason why is because they show us how do we issue a bond or a premium. What's the journal entries, right? So if you look at exercise 15-5, it's on page, I believe it's 677. Starts off with Swisher Company. Issued a $2 million bond on January 1st, 2017. Now, in Part A, it says, hey, we have different amounts here, right? You issue it at par, you issue it at a discount, you issue it at a premium. So let's just do the journal entry, right? So the first one says we issued it at par, right? Or we issued it at 100%. Or issued at 100, right? So we know that that's 100% of its face value. That means that it is par, right? So what's the journal entry? Well, first thing we need to do is we need to credit cash, just like we did before. Credit cash for the par value, $2 million. Or the face amount, they're both the same thing. And we credit bonds payable for $2 million. Okay. Now, number two, and remember, please skip a space between your journal entries when you're doing your homework. It just makes it easier for me to grade. Okay. Number two says it is issued at 98, right? What's that mean? Well, that means it's issued at 98% of its value, okay? So what we need to do is figure out, first, what is the journal entry, okay? Two, let's calculate the amounts. Now, the first step, what is the journal entry, okay? You should know this, you should have it on a note card already. This needs to be automatic, meaning you don't have to think about it. We issue a bond at a discount, 98% of its value. We have to debit cash always. We need to debit discount on bonds payable. Sorry. And we need to credit bonds payable. So, issue a bond at a discount, that's the journal entry you need, right? Automatically off the bat, you should know that, okay? Now we got to calculate the journal entry, or the dollar amounts. This is really easy. It really, really is, okay? Bonds payable. What's the face amount? Well, the face amount's $2 million. Okay? How much cash are we receiving? Well, we're receiving 98% of the face value, right? $2 million times 0.98 gives me $1,960,000. That's the cash that we as the company are receiving. What's the discount? Well, the discount is just the difference between the debits and credits. That's easy for us to figure out, right? It's going to be 40 grand, if my math is correct. Yep. Okay, perfect. Now, the third one says that we issued, at 103. Okay, what does that mean? That means that we issued this bond at 103% of its face value. Okay, so that means we issued it at a premium. Okay, again, first thing you got to know is the journal entry. This needs to be a no-brainer. Rote memorization. I'm debiting cash. I'm going to credit bond premiums. And I'm going to, sorry about that. And I'm going to credit bonds payable. Actually, it should be premium on bonds payable. That's the correct account name. Okay, so right off the bat, got to memorize this, right? You issue a bond at a premium. What's the journal entry? Debit cash, credit premium on bonds payable, credit bonds payable. Okay, again, now we need to figure out is what is the dollar amount? Well, that's easy, right? Bonds payable. Well, the bonds payable is $2 million. That's the face amount of the bond, right? How much cash are we receiving? Well, that's easy. We're receiving 103% of the face value. That's the cash we're receiving. So 2 million times 1.03. We're receiving $2,060,000. So what's the premium on bonds payable? Well, that's the difference between the debits and the credits, right? $60,000. Okay. Now, let's look at the redemption, and this is part B. Part B says, prepare the journal entry to record the redemption of the bonds at maturity, assuming the bonds were issued at 100%. So the bonds were issued at 100%. Okay, super easy. We're paying cash. We're getting rid of our payable. I need to debit bonds payable. And I need to credit cash. Okay. For how much? Well, the face amount, $2 million. Okay. Now, let's look at Part C. Okay. Part C is kind of interesting, right? Prepare the journal entry to record the redemption of the bonds before maturity at 98%. assume the balance in the premium on bonds payable account is $9,000. Okay? So, right off the bat, we need to recognize that what did we do? We issued these bonds originally at a premium. Okay? Some time has passed. Right? Time has passed. Okay. I'm cool with that. We are going to call these bonds, meaning we are going to retire them before they actually mature. At how much? Well, the problem says at 98%. Okay? Specifically, it says record the redemption for the bonds before maturity at 98%. 98% of their value. Okay? So, what's happening here? We are redeeming we're satisfying the liability. We're getting rid of the bonds, meaning we're not going to pay interest until maturity. We're going to call those bonds in. Okay? They tell us the amount that we paid for them. Or let me rephrase that. I'm sorry. They don't tell us the amount that we paid for them, but they tell us, hey, these were issued at a premium. We know that because we have a balance in the premium on bonds payable account. Okay? So, there's really a three-step process. First, we need to eliminate the carrying value. Next, we need to record the cash. And then third, we need to record either a gain or a loss. Okay? Now, for part C, and what we're doing here is redeeming redemption of bonds before maturity at 98% of the value. Okay? So, in order to do this, we need to ask ourselves, okay, what are the values in the accounts? And I got to get rid of them. So the first thing we need to do is eliminate the carrying value, right? That's easy for us to do, okay? We know that the bonds have a face value. We know that the bonds have a face value of $2 million. So that's our bonds payable account. Okay? And that's $2 million. Okay? The next thing, they told us that the premium on bonds payable account has a balance of $9,000. Now, bear with me here. Okay, so if we look at the T account for bonds payable, we need to recognize that, bear with me. There we go. Okay. We need to recognize that a debit actually decreases the premium on bonds payable account. A credit increases. Okay. We need to get rid of that balance, right? So premium on bonds payable, if I increase it with a credit, the normal balance side must be the credit. So it has a credit balance of $9,000. I need to get rid of that. So I have to debit that account. So I'm going to debit it for $9,000. We have now done step one. We have eliminated the carrying value. Okay. Bear with me here. Sorry about that. Okay. So we've eliminated the carrying value. The next thing we need to do is we need to figure out, or we need to record the cash that we paid. Well, the problem tells us we retired them before maturity at 98% of their value. So how much cash am I getting? Or how much cash do I have to pay? Well, I need to pay $2 million times 0.98, 98% of that, 1,960,000 is the cash. So the third step says recognize the gain or loss. Well, let's think about this, right? I have 2,009,000 in debits, or I'm sorry. Yeah, 2,009,000 in debits. I have 1,960,000 in credits. So we can see that we are paying less than the carrying value of the bonds. Guess what? We have a gain. So we're going to say credit gain on bond redemption. And the amount is going to be $49,000. Okay? So that is part C. Now let's look at part D. Part D says prepare the journal entries to record the conversion of the bonds into 60,000 shares of $10 par value common stock. Assume bonds were issued at par. Okay. So if we assume that the bonds were issued at par, we don't have any premium or discount to worry about, right? So for part D, conversion. Or conversion into common. Okay? Very easy for us to do, right? All we need to do is ask ourselves, well, what's going on? Well, I'm getting rid of bonds and I'm giving out stock. Perfect. I need to debit bonds payable. Why? Because I'm decreasing the bonds payable account. I'm satisfying that liability, right? Because I'm giving them common stock. So we're going to debit bonds payable for $2 million. Okay. The next thing we need to do, and this goes back to our previous chapter, we got to credit common stock, and we need to credit paid in capital in excess of par. Okay, so to figure out what this dollar amount should be, we know that how many shares are we giving? 60,000 shares at a par value of $10. That's $600,000. Put it in the wrong spot, sorry. So 60,000 shares times a par value of $10, that is $600,000. Debits and credits don't match, right? There's something going on here. What's going on here is there's a market value to the stock. We don't know what that market value is, right? We're taking $2 million worth of bonds and we're saying, okay, these $2 million are worth X amount, right? In stock. Specifically, you're going to get 60,000 shares. 60,000 shares. 10% of that value is part of the common stock account. This additional amount that we just have to kind of back into is that additional paid in capital. So if we run the numbers really easily, we get $1.4 million. Okay? And that, my friends, is how you do exercise 15-5. Okay? I kind of wanted to go through this one as I was looking at it because the previous problems were very simple, right? Very stated very simply, you're issuing a bond, face value, what are the journal entries, right? So we went through the journal entries for problems 2, 3, and 4. Keep in mind for problem 2, these are the dollar amounts. What are the journal entries? They're identical to this. Same thing for problem 4. These are the dollar amounts. What are the journal entries? Same thing we did in 1. Okay? So tune back in, and we're going to head back to the lecture portion and discuss a little more about bonds. So tune back in for that one.